Good afternoon. It is my pleasure, it is our pleasure, Yajas and I from JSA, to invite Juhi Puntambekar on this session for Chambers on Expert Focus. We partnered with Chambers to, talk about clients and our clients who are in the digital lending and finance space to come and talk about their experience. Just to introduce our expert panelists, Juhi Puntambekar is the head of legal at Jupiter Money. And what is Jupiter Money? Well, that's a good question. I will definitely let Juhi introduce Jupiter Money, but they were started in 2019 and they're one of the most upcoming, forthcoming, and promising digital banking startup. And they are basically into personalized money management, and they help customers take control of their finances. And they collaborate and partner with different financial institutions to provide easy solutions and as a breakaway from conventional banking. So that's a little bit about Juhi and Jupiter. On the panel, I have Yajas, who's a partner as part of the fintech practice, and my name is Probir. We're part of JSA, and our practice focus is fintech, and we're happy to, start this session. So without sort of, wasting much time and to really focus on the topic at hand, the topic is going to be on digital lending. That's really what we would like to discuss with Juhi and, glean from her experience because she has been in this field for many years. She started her career in 2015 and she's been working in the uh, fintech space for quite a few years. So we thought it'd be good to get her experience. Judges, you want to take the first question, then I
Yes.
can chip in? Yeah.
Sure, absolutely. Thanks, Probir, and hi, Juhi. Thanks for taking the time out to do this. So just an easy question right at the beginning, and something that I think many people who are in the audience who may not be very well versed with digital lending may want to know is, could you spend a little time introducing, the most common digital lending structures and give us an idea of the different entities and the different players in this ecosystem and some of the roles that they play? That'll be really helpful for some of our clients.
Sure. And first of all, thank you so much for having me here, Probir and Yajas. It is indeed a privilege to be talking about this topic with you, considering you guys are definitely one of the leading firms in fintech space. Having said that, yeah, let's start with the easy question. So digital lending is basically generally it's a triangle platform wherein three entities are usually involved. Since it's lending, there is a lender. That's number one. At least in India, where if at all your gross income is going beyond a particular threshold, you're expected to have a license from our central bank, that is Reserve Bank of India. So these lenders are usually banks or non-banking finance companies. So that is the first participant. Second is a digital lending platform, which is basically your tech platform, which acts as an outsourcing agent for these regulated entities. So depending on the commercial structure between these regulated entities and the digital lending platform, they may be providing various services. It could start with customer acquisition, supporting and underwriting, providing a particular platform for customers to avail these loans, collection services, etc. And the third one is, of course, the consumer. Consumer is basically the borrower, which is availing the loan from these regulated entities through the digital lending platform. So this is the usual structure in the players in digital lending.
Thanks for that. So that's great. I mean, I mean, this is, I guess, what you've given our audience is the sort of most basic structure of the most standard lending structures that we see. We've, frequently encountered structures that involve more players. For example, in some cases, we've seen merchants or brand owners get involved in the entire lending ecosystem, particularly for, whether it's buy now, pay later, or other sorts of lending structures. But absolutely agree with you that makes sense. That what we've seen is as well is that the most basic lending structures have these three players, each of whom perform their own sort of roles in this space. So, I mean, can you give us a little bit of your perspective on why the RBI, why is this space regulated, and what do you think is the reason for the RBI's sort of focus on this digital lending space over the last few years, particularly?
Sure. Actually, this is a huge market, and all the marquee players and lenders in India are trying to enter digital lending space. And the reason for this is that India has largest number of non-financially included customers. That means most of the Indians do not have formal sources of credit access. Few years ago, since they didn't have access to credit, it's a very common practice of them resorting to availing these loans from money lenders. These money lenders could be either available through digital or physical form. So since the market is huge, on top of that, we are also one of the highest consumers of data in the world. So what this means is that a lot of consumers require credit, and they all have access to data and internet. And therefore, this market has been growing. And since 2017, I suppose it has grown 12 times. And it is as big as about $350 billion. On top of that, the reason for RBI to step in was that it started from somewhere in 2020, where RBI came up with a small notification under their fair practice code. And all they said was, if you are a digital lending platform, lending and partnering with a regulated entity, ensure that there is a loan agreement and a sanction letter provided by the lenders. So the problem started from one end at A. RBI wanted to make sure that regulated entities were giving this loan, and B, the consumer knows that who's giving this loan, on whose books this loan is coming. That's number one. The second was, of course, since we are one of the highest access of data, and data is the new oil, and a smart data, as Mukesh Ambani says, is petrol, we should have control over our petrol and data. So therefore, RBI stepped in to even regulate the space vis-a-vis how the consents are taken, what sort of access these digital lending apps can take on my own mobile device. Unfortunately, there were a few events wherein certain applications were not taking the right consents. There were certain practices of contact scraping, and in India, credit is a taboo. On top of that, not paying your lenders is a bigger problem. So there were phone calls being made, collection phone calls to your relatives, informing them that you haven't paid the money. That was number two. Other than that, if there is a loan, the customers should know there is a loan and there is an interest involved. If you do not pay the money, then a penalty will be levied on you. So there was a need to even have that sort of numbers transparently reflected on that digital lending platform before a customer takes loan. So these were one of the many reasons why RBI stepped in and spelled out the most obvious things which were not being unfortunately followed.
So, Juhi, that's an interesting, thought process, and I think you sort of trace the history. But also, the RBI has been pretty vocal about, and expressed concerns with unchecked innovation, and I think in some sense, one can understand that the regulators and the regulation will never really catch up with technology. Technology does evolve at a much faster pace, that's the way it is. They're game changers. Companies like yourselves are game changers because you're breaking away from traditional institutions for allowing customers to, manage money. But the RBI also expressed concerns not only from unchecked innovation, but also a possible threat to the stability of India's financial system, because the Reserve Bank of India, which is the apex regulator, controls really not only inflow and outflow of forex, which is still, our currency is still regulated in many ways. Same way, the Reserve Bank of India also controls, banks and institutions in the lending space, in the sort of banking space, right? So they did come up with these digital lending guidelines, which is what I think you're alluding to. And this story started last year, and there's been sort of like a shift from where we were last year to where we are now. So could you perhaps elaborate on where the digital lending guidelines were, where they have been, and do you think they really address the concern? Do participants such as yourselves feel that it was a good move, and do you think it's benefited the industry? Could you shed some light on that?
Yes, absolutely. As you rightly mentioned, that RBI, being the central bank of India, kind of not just takes care of forex, but also the way everything about money, how it flows in, financial stability. So yes, in our opinion, RBI is definitely catching up to the innovation and even the threats of innovations which come in, right? So let's start with the financial stability you brought in. After digital lending guidelines came in, RBI also spoke about and came up with a notification on default loss guarantee. So if I could just even follow their RBI's thought process step by step. So as I mentioned, that considering most of the Indians are not financially included, and they are also not part of the entire database of credit history. Most of us do not have formal credit history. What this means is India does have certain licensed credit bureaus, and every time you avail loans, all the regulated entities sort of report your lending patterns and your repayment patterns to credit bureaus. So if you have a good credit history, that means you have paid your loans on time. That gets reflected. So yes, RBI also covered in digital lending guidelines that all the digital lending platforms, all the regulated entity, even if they're lending through digital lending platform, have to do reporting to credit bureaus. The second one about default loss guarantee is that since there is no credit history, most of the regulated entities would not bet on those who don't have credit history. And it's a chicken and egg situation, right? In order to get loan, you need credit history and vice versa. So all the fintech platforms were, because of their ability to underwrite loans by using alternate data, were ready to bet. So there was an arrangement taking place between the regulated entities and fintechs that a certain percentage of non-performing assets will be covered, or the guarantee of that will be given by these fintechs. So while if I don't pay my loan on time, it will be reflected in my credit history. But these REs, the regulated entities, will sort of have a guarantee from the fintechs. So their books do not get affected. This indeed was posing sort of a systematic risk because the regulated entities are using public funds for lending. In case, due to whatever reason, the fintechs who do not require to maintain a debt to equity ratio, or for that matter, a liquidity coverage ratio, are not able to obliged to their default loss guarantees, they would not be able to give that sort of pay back the guarantee amount to these REs. So RBI stepped in, and for a few months there was a lack of clarity, but what we were reading that now these default loss guarantees may not be applicable at all, and we are not allowed to give these default loss guarantees to the regulated entities. But honestly speaking, RBI is definitely one of the most sophisticated, and they have a great understanding of the market, because if fintechs do not get to bet and provide these default loss guarantees to regulated entities, the new consumers to credit will never have a shot, and we'll go back to a market where most of us do not have access to formal sources of credit. So lucky for us, RBI came up with a cap that at any instant, you may give default loss guarantee up to 5% of outstanding amounts. And in order to safeguard the market stability, financial stability, they also said that this is not an unsecured obligation. It's backed by 100% margin. So at the time of signing an agreement, giving the guarantee of 5%, fintechs also had to provide a security in the form of a fixed deposits or a bank guarantee. So yeah.
Great. And Juhi, just to add a few points from our perspective there, when these regulations did come out about updated FLDG norms, I mean, we felt like 5% was too low, but then the more we spoke to players in the industry like yourselves, many people actually seem to think that 5% was quite a generous threshold. And we heard very positive things from different players. And I truly think that given the sort of doomsday scenarios that different fintechs were talking about last year to what we're hearing today, we're hearing a lot of very positive messages today from a lot of the digital lending companies that we've been working with. So I completely agree. From what we've heard as well, the guidelines and the clarity that the RBI has given has really given stability and predictability, as well as there is at the same time some level of checks and balances to how this business is operating. I think the 5% threshold has sort of in some ways rooted out and weeded out some of the players that perhaps were not the most sustainable and perhaps that didn't have the most sustainable business models. At least we've seen that some of the companies that perhaps were offering much higher thresholds and perhaps were making loans which they couldn't cover or wouldn't otherwise want to lend were hit by those regulations. So I think that we've seen pretty positive feedback from the industry on that.
And to your point on, sort of putting in place a structure for these entities, Juhi and Yajas, also the data practices that companies used to follow, why don't we, I think we can talk a little bit about the current data practices, guidelines prescribed, and how does that really going to affect businesses? So
absolutely, I think that's a fair point. I think a lot of our clients have at least expressed to us that some of these regulations regarding data collection, requiring consents for particular specific types of data, as well as prohibitions on collecting or scraping data from phones. Some of these things have been received quite well by the industry. And that now with the sort of advent of India's new data protection law, I think it's definitely going to inculcate some discipline when it comes to data privacy practices in the fintech ecosystem. I think that's definitely something that we're hearing from several of our clients. And Juhi, I think you also mentioned briefly, but I would love to spend some time because you expressed to me very during our last discussion how simple things in the regulations are actually doing a lot of good when it comes to things like user harm and maybe somebody who's borrowing a loan for the first time, who's never used a digital lending app, how some of these regulations are benefiting them. So if you want to just take us through that, for example.
Yeah, absolutely. So I'll start with a concept called cooling off period. I was personally very excited about that because while digital loans are quite seamless and it's very easy to avail a loan if once you're approved, it should also at the end of the day feel like a loan. It should feel like you have the obligation to pay, and if you don't pay, as I mentioned earlier, there'll be a penal provision, and you need to be ready for that, and you need to understand that in detail. And what cooling off period basically meant that a certain time period should be given to the customers to change their mind. They should be able to either cancel the loan, and if they cancel, then only processing fees can be charged to them on pro rata basis. So while this concept was always provided in insurance industry, they called it, I think, a free lookup period. This was not followed to the T in digital lending. So this was very important concept to be introduced. The second one was probably, as you rightly pointed out, that before data protection law came in the country, we were starving for something which kind of gives us control over our own data. So digital lending guidelines did say that digital lending application have to desist from using unnecessary data. For instance, they do not need access to my phone calls, contacts, cameras, gallery, etc. Right? So those sort of checks and balances were required to be introduced. It was very interesting to see how the entire ecosystem started working towards putting in checks and balances. Google Play Store, for example, was very responsible. They were holding applications accountable to show that how these compliances are followed. And if you were not following them, they were deleting and removing you from the App Store. There is a concept of enhanced due diligence required by the REs to be performed on digital apps. So it's quite interesting to see that whichever regulated entities we are partnering with, they are doing that sort of very detailed due diligence to see if those data practices are followed. But I would love to hear from you guys that how beyond digital lending, how the data protection laws are affecting other tech players of fintechs.
Yeah, no, I think that's a great question. A lot of our clients are sort of dealing with sort of traversing through that terrain. Some things that we've seen very interesting is before it was much easier for tech companies and fintech companies to sort of cross-sell products. So if you were an insurance application pivoting overnight and becoming a lending platform, or if you were a stockbroking entity and then becoming an insurance intermediary, those sorts of things were much easier because you already had the client's data. And then you chose what you wanted to use it for. Tomorrow, if you wanted to start promoting, some co-branded credit cards, it was very easy to do it because you already had the data. Today, I think our clients are sort of pausing and saying, wait, what did we collect this data for? What did we tell the customer when we collected that data? Do we need to again go back and tell the customer that we are now promoting this product? Give us your consent to use your data for these products. A lot of our clients are having to pause and rethink some of their the way they used to interact with the customer previously, and that's been a very, I feel, a very healthy discipline that's come, and it's coming not just at the in-house counsel or it's not just a discussion between the in-house counsel and the law firm. It's now we're seeing these discussions happening at the board level. We're having calls with CXO level people within the company, because they realize that of course there's going to be business pressure. There are going to be people from the product team who are going to say, this is going to delay my launch by 2 months, 3 months. I can't go and give consent. But now with the new law there is a reason for the board to listen to what the in-house counsel or the legal counsel and lawyers such as ourselves have to say. Some of our larger clients have actually appointed chief data protection officers already, who are sort of in sort of imagining how the data flow works within the company, and sort of doing a ground up type rebuild of their data practices, which is all, I think, very healthy in terms of, and it's also sustainable, because that means that you can grow. What we found is that the larger the company is, sometimes the harder it is to fix issues, because there's a lot of legacy databases, legacy infrastructures, contracts and terms which you didn't think about. So simple examples, like if as a fintech company, if you have a contract with you've collaborated with a bank or a NBFC, for instance, and you have agreed to certain things in that contract with respect to data privacy. It may be something as simple as notifying them when there is a request for information from a regulator, or notifying them when the customer requests for the information, those kinds of things. Now, when you're doing your data privacy compliance and you're reusing the customer's data for a different purpose, not only do you have to look at the law as well as your licenses, but you also have to think, have I contractually sort of told somebody that I will not do this, or have I made certain obligations to in my contracts with my partners, which I need to be mindful of. So these are all things that we're seeing people revisit, and we're helping clients, sort of create policies around things like this. So overall, I think, and particularly in the digital lending ecosystem, because like you said, this is one of those ecosystems where there are multiple parties. At any given time, there are 3 or 4 different players that are accessing fairly sensitive information. So it's really important that data is most people at least know where the money is going. Very few people till now knew where the data was going, but now I think there's a lot more transparency. So
I think
that's been pretty good.
also to your point, and Juhi, like there are two kind of clients we have in India. We have global conglomerates who probably are working in US, Europe, who are used to a GDPR construct. And when they are operating in India, the concept of privacy is not an alien concept, right? So there are principles of GDPR which companies were following. Of course, in many ways, our new act is more stringent and got narrower in interpretation than the GDPR. But Indian fintechs, Indian innovators, because privacy as a concept has been very alien to Indians, right? We just sign the TOS end user term. We don't really, as consumers, and even as like fintech and tech lawyers, the question I ask is that we advise clients so much on detailing and putting in place information so the consumer is aware, but how many times have I or Yajas really gone into, we have, all the finer nuances on the application that we use as users, right? We don't. And then to have that discussion with Indian innovators, Indian businessmen, and to explain to them, that now there's a new era, there's a new age of informed consent, of enabling the consumer to actually come and ask questions, seek modification, seek deletion. These are concepts which are being brought in by the Act. So there is going to be this sort of struggle and turmoil to actually, look at what the Act is and take a change in implementing the business practices of a lot of the companies. Because as you said, at the beginning of the session, Juhi, that in India, fintech is the new sort of oil, right? Data is the new oil, right? Everyone wants to capitalize on it. The cities that we live in are not the cities that clients are focusing on. It is the tier B cities, right? There is so much of the middle class who are educated, who have access to technology, who are really coming onto the platform, right? So of course, there's a push for the business to actually grow, but there is also this requirement to understand the risks and the compliance requirements that the legislation has. And in fact, Judges, maybe it's a good time to also talk about the consent manager framework, which has sort of been brought in by the Data Protection Act. This is a very new phenomena, right? It's probably the first time, I think, anywhere that we have this concept, and India has brought that in. And it'll be interesting to see, that how will this consent manager interplay with companies like Jupiter or other people who are in this space. So maybe we can talk a little bit about the consent.
Sure. And I think Juhi and I briefly touched upon the topic during some of our previous discussions. But basically, with India's data protection law being so heavily consent sort of driven, and the whole basis for the law being consent, there was this obvious worry that consent may start becoming futile, because it's just that you're just going to get fatigued with notices and consent, and everybody's just going to say yes to everything and not bother reading it. So then, we were having these discussions with important stakeholders within the government, and they seem to be of the view that there are tech ways, tech solves for these sorts of problems. And one of their proposals was, why not consider an intermediary, somebody who sits between a data controller or a data fiduciary and a data principal. That intermediary can be responsible for, breaking down sort of the different reasons for which you have given consent, the different people to whom you have given consent, and help you or give you a more user-friendly dashboard or way of managing that, right? And that is essentially has been introduced into the law now as a sort of consent manager. Many of our multinational clients are seeing this even as a concept. This is not something that's very popular it actually is not prevalent in any other countries, and even it's a very purely academic discussion in other countries. in India, the government has really pushed for this and is hoping to receive applications, I believe, for consent managers. We'll have to wait to see. Maybe Jupiter will jump onto that. I don't know if Juhi, you would spearhead that, I'm sure. But that's essentially what we're seeing. So the government seems to think that even if it's consent based, there are ways in which we can make consent easy to understand and easy to control. So the world that the minister and different people within the government have explained to us is a simple dashboard or platform where you can see, oh, these are the 5 companies that have given access to this data. I can switch it off and switch it on at any time, that I choose this one. And it then becomes the responsibility of that consent manager to coordinate with each of those companies and explain. So that seems to at least be the way the government is looking at it. That it may be a sort of simplified, I'm sort of oversimplifying it for sure, but the government seems to think that that's the best way of helping, rather than using a GDPR model of legitimate purpose and sort of putting the burden onto the companies to decide when it is legitimate and when they can't call it legitimate and they should go and get consent. Taking that responsibility away or accountability away from the companies in that sense. So I think that's something that we're seeing a lot of our clients quite interested in.
Yeah. I think that will be super useful and user-friendly for companies as well, because if we have an interoperable platforms through which these consents can be managed, and that could be the next UPI moment for us then.
Yeah, absolutely. That's exactly. I think the idea would be that this is something which is interoperable, probably sort of mobile phone agnostic and technology agnostic. It's something user friendly and sort of interoperable. Yeah.
Since we are on user friendly, and making it sort of more easy to access, so Juhi, what are your views on self-regulation? Because I think the finance minister and the RBI also came up with some kind of comments that maybe one way to actually regularize the practices in the fintech industry, in the especially digital lending sector, is to have SROs, right? And if that would be one way of promoting responsible practices, ethical standards. So basically, organizations look at themselves and they look out for each other. Also, probably rap someone's knuckle for not really following good practices, right? But again, I mean, as a concept, yes, it sounds great, but wanted to check with you, from the industry perspective, what is it that your view is on sort of SROs? That's sort of like a first step, checkpoints to look at what industry is doing, how people are following best practices, whether it would actually work or not.
Absolutely. I think we are a very big propagators of the concept of SROs. That's also because this is such a niche industry and there are so many variants to the products we offer, right? Like Yajas initially mentioned that there are even merchants involved. So there could be a personal loan and there could be a loan where I buy a particular cell phone from an online merchant and the money gets the loan amounts gets deposited directly to that particular merchant's account and not my account, right? That is one variant. The other variant could be, say, a 1-month loan versus a 12-month loan. So while I totally agree, RBI has really taken their time to study the market. Their working committee report was extremely thorough, but expecting them to go into extreme nitty-gritties would be, I think, unreasonable, and it's probably not possible. So if we have, say, an SRO which kind of keeps checks and balances on each other, basically the players are keeping checks and balances, it'll be very useful for consumers also, because for, say, a 1-month long loan, they need not have too many documentation. Like you need not give them, say, a calculation of your loan in case this loan extended for 1 year, but you need that sort of calculation for a relatively longer period loan. So it will be helpful for us to probably have that sort of checklist in place, and an SRO will be a very welcome change for us. Yeah.
Right. Yeah, I think Absolutely. I think that, and it's great timing as well. We've been seeing that the Indian government and also different regulators have been very, I mean, have been very favorable towards SROs. They are sort of encouraging industry players in different sectors to sort of self-govern and self-regulate. We have seen this when it comes to gaming companies. In the intermediary rules, you have SROs for real money gaming companies. For a long time now, you've had SROs for OTT and streaming platforms. So your Netflix and Amazon, they have their, or Amazon Prime, they have their own sort of self-regulatory organizations. I think anywhere where there's technology involved, thankfully the government and regulators have realized that when there's technology involved, having a very top-down prescriptive sort of approach is not possible, because the technology and the business models change so quickly. By the time you come out with one circular, there are already 10 different business models, 10 different issues to solve, and things to regulate and things like that. So I think that they have seen that and also because of this, like you said, the sheer diversity of the companies, the nature of organizations, because to be a technology company, the barrier is so low, right? Unlike being a bank or an NBFC, where you have to first raise that much capital, you need to first become of a certain size, only then. So that sort of restricts how many people that there are. But in the technology space and the fintech space particularly, the barrier is not that hard. It's probably not so difficult to become a technology player, to become the basic sort of tech player. And therefore there needs to be something else other than an RBI focused top-down sort of regulation. And I think that we're seeing that in all the different business model, verticals that are sort of popular in today's thing. We've also seen the Minister of IT basically say in the Digital India Act that the Digital India Act is not going to be a very prescriptive and sort of rule-based law. It's going to be principles. And then you have high-level principles, and then within that, we will leave it to the industry to decide,
Correct.
with these principles, what further are you going to do? How are you going to sort of govern yourselves? And that's a very encouraging sort of development that we're seeing in the government, particularly in the last 4 or 5 years. We've been seeing the government quite, sort of positive when it comes to self governance. And I think we're seeing this in many of the newer sectors that are coming up as well. So absolutely agree with you on that point on self-regulation.
Actually, it's interesting. You're giving me openings by using words like you said, um, tech companies. But Juhi and Yajas, I think the point is that now, on account of sort of the regulation that the Reserve Bank of India has come up with, but do you not think that this era of tech first, because that was how sort of the innovation led, right? Everyone was, let's focus on the tech, let's focus on the product. It's okay. We will leverage a partner's licenses. We will leverage or collaborate, as that's what, Juvi was mentioning what Jupiter does. But do you not both don't think that the era of this tech first companies is actually sort of on the end and decline? And it's no longer going to be like tech first, but it's going to be about companies having to sort of own up, be responsible, and have a skin in the game by actually being, regulated and taking the onus of actually being a licensed entity. Sort of, either you and just whatever you can sort of give your thoughts on this.
So when it comes to being regulated, so as I initially mentioned, say we'll start with fintech companies because that's the topic of discussion. So RBI always regulates banks and NBFCs, which are finance companies, finance providers, etc. Right? And RBI always had a concept of, say, responsibility of an outsourcing agent, that is subcontractors who provide other services to these regulated entities. So many of the responsible industry players, barring probably, so what outsourcing guidelines say initially did was they kind of listed out things these banks and NBFCs can or cannot outsource. So there was very strict set of regulations which these regulated entities had to follow and had to ensure that tech counterparts or other companies are following it. So in my opinion, for companies which are providing, say, digital lending support to these regulated entities had to follow indirectly a lot of regulations. So, so the new changes which digital lending guidelines say brought in was concept of non-pooling of funds, something like the money has to be going in the account either directly to the end user or a payment aggregator's account. That was one. Second was all data practices which came in, which were not there. Other than that, in my opinion, say customer service, collection practices, KYC collection practices, all of that was already there indirectly. But since the market was growing at such a rapid pace, a new set of laws came in spelling out what these digital lending applications have to be doing. So in my opinion, regulations were always there, but I want to hear Yajas over that.
No, absolutely. That's a very fresh perspective. I mean, to be honest, what we had seen was like some time ago, like 2014, 2015, there were companies that were doing very well, very successful fintech companies that were completely outside the realm of any sort of direct licensing and regulation, right? When I say I should probably not say not regulated, because I completely take your point. They may not have been licensed entities, but because of regulations like the outsourcing regulations and the RBI's various other regulations, their actions were regulated in some ways because they were still responsible to the RBI, at least by contract and things like that. So I absolutely take your point. There were companies before, when which chose not to sort of be licensed and instead worked purely as tech platforms for anything, any business that they offered or any product that they offered. They used to collaborate with other licensed players. As time has evolved, and I think the industry has matured, we've seen more and more tech companies be very comfortable with getting licensed themselves. So many of the fintech companies that you see today are also registered insurance intermediaries, corporate agents. They are also, happy to call themselves lending service providers or digital lending apps. They are happy to call themselves broking agents from a SEBI perspective. So they're sort of that fear of, let's try and operate outside the regulated space and sort of be clear of all regulatory scrutiny. That has definitely changed. We're seeing that companies have realized that, particularly because the RBI has been fairly conservative and strict about certain things such as data flow, data sharing, and as well as KYC related regulations. So I think that companies have realized that to grow beyond a certain point, they need to accept the fact that they need to comply and they need to sort of submit themselves to some form of scrutiny, either directly or indirectly. And I totally agree with you that in any case, these digital lending guidelines, for example, they introduced a few new things, but a lot of the principal substance was always there, but it was probably scattered around in different regulations over the period of 10 years. Now it's all sort of been brought into one place, and the intention of the RBI is made very clear.
Okay, but that's a good perspective. Yeah, I agree. I think you're right that compliance and regulation is the way forward. With the regulator, companies operating in India will have no option but to sort of look at compliance and regulation. I think it's a good sort of way to wrap up our discussion is to probably ask Juhi if you have any sort of asks. As one thing JSA does, is that we do interact with the regulator very often. We represent a lot of our clients and industry stakeholders and taking their comments and feedbacks to the ministry as there are new regulations. So just wanted to check, that do you think that from a digital lending perspective, companies like yourself, which are in this space, is there anything else that you would like, sort of you think are sort of key concern areas where people or clients like yourselves would like to see either sort of more clarity, would like the government to come up with sort of new initiatives, anything else that you think is plaguing the system, or you would like the government to elaborate and help make doing business in India slightly easy from a lending perspective, of course, then we could sort of take that back and sort of sum up the discussion as what else is required to make this sort of process easier for clients to operate in?
I think there is enough clarity vis-a-vis digital lending for now, because, as I said, there have been series of regulations given by RBI. The only thing we are eagerly waiting and hoping to get a clarity on SRO, self-regulating organization. So in case there can be details, code of conduct, do's and don'ts as to how to go about it, would be probably very useful for us as an industry. And that's all I can think of. Yeah. But what about you? Do you think there are still some lacuna or gray area in the digital lending ecosystem?
No, I mean, of course, there's definitely some. Otherwise, I mean, as outside counsel, we don't have too much to offer our clients if everything was very clear. But it's interesting, Juhi. A few months ago, we were speaking to one of our clients who was actually a founder of a fintech company, and we asked him the same question, and he said, leave all the specific, complicated, complex nuances of what is the percentage of, all of that aside. He said that what would make my life much easier if the most basic things were clarified by the government and in the law itself. Simple things like this signing documents using electronic signature and digital signature and why is it still so even if I come to law firms and ask you for a legal opinion, to understand the legal opinion that I get, I need to call you, and then so some of those most basic things can actually be made simpler, and that would really make the life of a company easier, because then I know I can with full certainty. Otherwise, every time I make a decision, I need to also tell myself there is this amount of risk. It may just be 5% or 10%, but I know there's that much risk. If there was that risk was not there, I could make decisions much more easily. So it's actually interesting to hear from businesses and companies. Sometimes the easier, the lower, less complex the problem, the more it can be, more important it can be for the business.
Yeah, that's a very good point. Even we haven't figured out, I think most of the industry players haven't figured out how to digitally sign loan agreements. Yeah. So click wrap. It is.
Yeah, exactly.
Well, going back to all the basics. With that note, thank you so much, Juhi. Thanks for taking time out. I'm sure all our clients in the larger sort of audience who will be looking at this expert focused podcast on Chambers, which is a global platform, will definitely find this session useful. And we look forward to sort of collaborating with you on future pieces. Thank you. Thanks so much for your time. I'm going to stop the recording now. Yeah.
Thank you so much. Thanks a ton, Probir and Yajas.